I wanted to thank you for joining me on this episode of Doing Insurance Right. My name is Scott Jenkins. I'm your host. I'm a local farmers insurance agent here in Phoenix, Arizona. And today we're going to talk about the used to be pension plan that seems to no longer exist, and can an annuity kind of act as a pension plan? So retirement planning obviously has changed a lot over the last few decades, and probably the most dramatic change that has happened over the last few decades is the death of the employer-provider preventions. The reason for that is that pension plans are extremely costly for businesses. So the private sector has largely transitioned to what they call 401k plans, 403b plans, which the workers contribute to, which has resulted in plenty of new challenges and including need for Americans to take charge of their investments as well as the rate of their retirement savings. Nobody ever complains about their pension. The reality is that Americans never wanted to go to 401ks, but when they went there because companies couldn't afford to offer pensions more, is what happened. So for those that don't have the backstop of like death benefited pension plan, however, annuities could be an attractive way to kind of build guaranteed retirement income that most Americans that had pensions enjoyed in the past. In fact, there was a study that came out recently here that less than 20% in 2011 were going to qualify for what they would call work pension plans. So what kind of annuity could work for you? So the basic feature of an annuity that makes it attractive to savers is a promise of a guaranteed income stream for the rest of their lives. So commonly you'll pay a lump sum premium as initial investment, and then your annuity pays you back at a predetermined rate set on the schedule of how old you are at that time. Something to similar as life insurance would be on how much you're going to pay in premiums. An annuity is going to be how much it pays you back depending on your age. So there's going to be two basic forms of an annuity. One's going to be immediate, just like it sounds. Immediate is going to be you deposit your investment and you start getting paid back right away. A deferred annuity is the second type, on the other hand, starts paying you back when you tell it to in the future. So let's say, for example, you got a lump sum payment of $100,000. You're 50 years old. You don't want it to start paying until you're 60 years old. You can defer that money and that continues to grow. Just give you an example, a 70-year-old man investing $100,000 in an immediate annuity, getting 6.4% for the rest of his life, gets $534 a month, where a 53-year-old man depositing that same $100,000 in a deferred annuity could get 7.2% and an annual return of $599 a month, but those payments wouldn't start until age 60. So basically, to get the same amount of money or just a little bit more, he would have to defer those payments for 7 years in order to qualify for that. So then when you get to annuities, there's a couple of different things. There's going to be what they call a fixed annuity or a variable annuity. A fixed rate annuity is where a provider pays you a fixed return on your initial investment across a specific time frame without any risk or changes in the future. So this actual annuity here is going to be a fixed amount. It's set in stone. If the market goes to tanks, you're guaranteed 7%. You're still going to get 7% on the annuity. Where a variable rate, you may see, higher in the teens for a return, but you can also see, lows or negatives even in that. And then there's also equity indexed annuities. These are going to be indexes such as the S&P and the Russell again. We've talked about these previously in life insurance episodes that we've done here on the podcast. It's the same type of thing on the annuity, except on the paying inside, it's on the paying outside. So they're going to be based on like with the S&P performance or the Russell performance as well. They can have caps and floors to try to help you out with that. So this is basically just kind of a brief overview of annuities and what they do. It is a great way to have a set stream, a fixed stream of income. So let's say I'm planning on retiring at 65 or 67 or 70 years old. I have money. I can contribute into the annuity as well over a fixed period of time, have that money and keep that money growing, and then have a basic, let's say I want a payout when I start at 65. I want it to pay me a check for the rest of my life. You can do that and have that set up very easily. So make sure you talk with a financial advisor or like myself, a farmer's agent. We can also help you set up a fixed or a variable annuity, immediate or deferred, any which way on those. So I wanted to thank you for joining me on this episode of Doing Insurance Right. As always, if you could rate, review, or subscribe to whatever platform you're listening on, whether it be Apple, Chrome Podcasts, Stitcher, Spotify, any of those, iHeart, or any of the new ones coming out, Pandora, please do me that favor. I greatly appreciate it. And I look forward to seeing you on the next episode.